I think what gold sees coming is what we see technically, and that is a lot of markets where a lot of assets have been committed and hopes based upon and inflated by the Fed over the past dozen years plus through cheap interest rates and money flow. When those break, it's going to be painful, and painful in areas of the economy that the Fed cannot put up with. In other words, cannot allow. So anyway, gold sees this, and it knows ultimately, no matter what the Fed said for the last year or so, that's going to go by the way. And the central banks are going to go back to liquidity, easier rates, et cetera, meaning what they do best, which means inflationary policies. And that's why gold is pushing at all-time highs.
Examining market trends over the past 50 years, renowned analyst Michael Oliver has discerned a consistent pattern in the behavior of gold, silver, and mining stocks. Typically, silver and mining stocks tend to closely mirror the movements of gold, albeit sometimes with a slight delay before catching up. This observation underscores the enduring value of gold as an asset, given its extensive history spanning thousands of years. Meanwhile, Michael notes that newer players in the market, such as the S&P 500 and the Federal Reserve, have emerged relatively recently, with roughly a century or less of existence. However, the Federal Reserve, known for its historical influence on commodities through its policies, may encounter challenges in managing downturns in sectors like the stock market and real estate. If these sectors experience significant downturns akin to the 2008 financial crisis, the repercussions could extend far beyond those directly involved, potentially leading to widespread panic and economic uncertainty. Michael emphasizes that the current market climate surrounding the stock market is marked by cautious anticipation, with market participants closely monitoring developments. Typically, shifts in the stock market prompt central banks like the Federal Reserve to employ familiar strategies, such as interest rate cuts, to stabilize the economy. In light of recent events, several central banks, including the Federal Reserve, have hinted at their readiness to implement multiple rate cuts throughout the year, particularly in response to concerns stemming from the bond market's downturn last fall. Interestingly, the price of gold surged to a record high recently, following indications from the Federal Reserve suggesting the possibility of 3 rate cuts in 2024, despite recent reports indicating elevated inflation levels. Michael predicts that gold may continue gaining momentum if investors anticipate more aggressive rate cuts from the Federal Reserve. However, there are emerging signs that buying interest in gold may soon begin to wane, signaling a potential shift in market dynamics. Stay tuned for excerpts from Michael Oliver's interview with Liberty and Finance. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
Historically, you go back 50 years and look at the various bull trends in gold and coincident bull trends in silver and the miners. They quite often will lag. They'll go along with the gold bull, but they'll be weaker until late in the bull trend. For instance, the last 2 bull trends in gold and silver, silver accelerated massively, especially in the last year of the bull market. Now, you remember, this bull market in gold is not new. It's been underway since a low in 2015, so it's a lot of years, and we've only doubled plus. And most of the gold bull markets were 8-fold moves. And we've got events around us now that are horrific in terms of potential dynamics of certain markets going down big. I think the stock market is a trap. I think the teasing new highs that we've seen above the highs of 2 years ago, which so far has only been marginal, by the way. S&P is like 5% above those highs. It took it 2 years to get back up there. We don't trust it, okay? But I think what drives gold is not so much the day-to-day headlines and things that people would like to link to gold movement. You're like, oh, this data came out and therefore gold went up. Gold has been around for 3,000 years. Okay, S&P has been around since 1950s. The Federal Reserve has been around for a century. So they're baby markets compared to gold. Okay, and I think what gold sees coming is what we see technically, and that is a lot of markets where a lot of assets have been committed and hopes based upon and inflated by the Fed over the past dozen years plus through cheap interest rates and money flow. When those break, it's going to be painful, and painful in areas of the economy that the Fed cannot put up with. In other words, cannot allow. They like to break commodities, they say, although commodities, we'll get to that in a minute. What they're going to break and our assessment is they're going to break the stock market and some other related markets. Real estate's already in trouble and so forth. But when it breaks, remember 2008 and 9, remember the in the street pain that people felt, even if they weren't in the stock market. They got laid off, et cetera, all kinds of hurt and doubt. And when that happens, panic sets in. And I think the stock market is in a teasing last mode here in terms of its upside probing. And when it fails, it's going to surprise people and that's when you'll start to see those data points that everybody likes to point to suddenly change. They won't change ahead of the stock market. They'll change after the stock market. That's usually the way it occurs. And that's when the Fed, the other central banks, will have to revert back to what they do best. And they've already said, we're going to cut rates 3 times this year. Okay, just a matter of when. Why did they say that? One thing that concerned them is their bond market crashed last fall. That concerned them greatly. So anyway, gold sees this, and it knows ultimately, no matter what the Fed said for the last year or so, that's going to go by the way. And the central banks are going to go back to liquidity, easier rates, et cetera, meaning what they do best, which means inflationary policies. And that's why gold is pushing at all-time highs.
Michael's analysis of the current stock market reveals lingering concerns as certain sectors struggle to regain their pre-2022 levels, indicating ongoing challenges. While segments like small caps and specific banks show promise, over-reliance on a handful of stocks to drive overall market growth raises eyebrows. This scrutiny extends to the banking industry, which appears vulnerable beyond its immediate scope. In examining the recent performance of the XLF, a broad financial ETF, Michael highlights a precarious situation despite recent highs. This underscores the market's fragility, with even minor unexpected downturns threatening recent gains. Meanwhile, attention shifts to the Treasury bond market, often linked to movements in gold, suggesting an imminent upward trend. Signals from the 30-year T-bond futures and TLT, an ETF tracking long-term U.S. government bonds, support this sustained uptrend observed since October. Amidst looming uncertainty, investors may pivot towards alternative assets like gold and government bonds in search of stability. This potential shift in sentiment could drive up the prices of these assets, solidifying their status as safe haven investments amid volatile market conditions. Let's get back to the interview.
You look at the stock market and various components of the stock market, and small caps and medium caps aren't, and banks aren't, and there's a lot of sectors that aren't back to the 2022 highs. And therefore, the stock market's been led by, we all know, a handful of stocks. Everybody knows that now. But they seem to think it's going to last forever. Okay, we doubt it. But as far as the vulnerability in the banks, I think the vulnerability is going to be pretty broad this time. And I would also be looking for example, right now, the XLF, which is the broader financial ETF, includes some banks, has just made a marginally higher high than it made a couple years ago by decimals. It's made a new high. So no doubt people are going to cheer that. It is in the same position as the S&P. It can't sneeze. If it does, I'm going to blow a floor out on its monthly momentum that will suddenly yank it from its, quote, new high back down into some depths. So I'd be looking more broadly than the banks right now. I know there's a lot of attention focused on that. But quite often when markets break, it's things other than the things that are being watched that cause the upset. Why? Because they surprise. Right now, everybody, they've been hearing about banks for over a year now. So there's no surprise element there. So I'd be looking elsewhere, like the broader financials. And there's other subsectors we're watching as well that have extreme technical vulnerability. And meaning they could suddenly shift from being good-looking sectors to be into vastly underperforming sectors. And I think it's likely that the ambush comes that way. And also the T-bond market, which has been over time, this is a true statement about its relation to gold. There's times when T-bonds move with gold, or when their price goes up and yield goes down, gold's going up. There's times when the opposite's the case. So it's not always the case that it's totally in sync with gold. But right now it's slightly lagged to gold, actually. we're watching both long-term, the 30-year T-bond futures, and TLT, the ETF of long-term U.S. government bonds. And they're both very ripe for upside breakouts that will continue. The surge that we had from that October low last year was vertical. We expected the crash and we expected the vertical low. But since December, they've backed off modestly, not terrifically, but they're not giving up the gains from that October low. That shocked the Fed, that collapse. But the pullback we've seen in T-bonds lately, meaning higher yields, we think is about to be arrested, and they're about to go through the price levels we saw back in December, meaning rates go down again.
As gold continues to trend higher on Thursday, investors are closely monitoring its trajectory toward a test of the record high at $2,222.915. With no resistance beyond this level, there is significant potential for prices to continue soaring. The possibility of delayed or reduced rate cuts, combined with gold's status as a safe haven amid global tensions, indicates a stable to slightly upward trajectory for gold prices in the near term. Share your thoughts on Michael's prediction in the comment section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.